Welcome to Market Diary, September 2023. Now, September was not a great month for the market. A lot of macro news that happened that caused a lot of scares, a lot of bond issues, a lot of equity cycling. It was just a lot that happened. And yeah, we also re-rotated back into a couple of things I sold back in July. So it was an active month for me, but it was a lot of holding through the pain. And I think it's a good discussion to have. So now, I said I returned to a couple of my X's. The first one was Microsoft. Now, I re-entered at 317.96 per. Now, if you remember, I sold it at 350. So I did re-enter at a point where, I didn't lose a lot off the top because it's dropped like 40 points since where I sold it. Now, Amazon, I also got back in, but I got back in at the almost exact point where I left it. So I missed the rise and fall from the earnings that you'll see from right here, because I pretty much sold here at this level, and I rebought here at this level. So I just missed this entire chunk right here. So if I had sold anywhere during this period, I would have made more money. But that's not the point. The point is I got back in here. Now, I did not get back in fully. I got back in at 5 and 5, so only like 5-ish% for Amazon and like 20% for Microsoft, because I had 20 and 54 shares respectively. So we didn't fully reinvest, but we put a little bit more in. So I have a little exposure here. Now, if you remember correctly, I took all of my earnings from those two shares and dumped them into the general S&P. Unfortunately, I did that at a high point. So the VOOG I bought at 415, and we're all the way down to under $400. So you can see there was a massive drop there. Now, the growth side didn't do much better. I'm down from 260-ish down to under 250-ish. So like we have seen some pretty significant drops in the S&P. I'm expecting this to get worse. So far in October, it has gone worse. And just until the market stops scaring itself because of a couple of leading indicators indicating that we're not going to have a soft landing and that we're going to have a pretty hard recession hit soon, people are scared and people are switching from equities into bonds, which is a normal thing to do if you're trying to be risk averse. So I'm expecting a little bit more pain as people pull their money out of the market, and the market's just going to go down as people are selling. That's just how that works. It will come back eventually, but it won't be anytime soon. So good thing that I don't need access to this money soon. Small caps, big losses. Yep, that pretty much tells you everything you need to know. We bought way up here at like 206, and it's down below 190 at the moment. Same thing for the growth side of things. We bought way up at 236, and it's down below 220. So again, the small caps are not doing much better than the larger market. Everyone is pulling out of equities right now. That is about all we can say about like the larger macro trends. The economy itself isn't bad yet. A lot of this is a self-fulfilling prophecy. So we will see what happens for the larger trends, but I'm still willing to hold through the pain. I think it will take a year or two to get back to where we were. And if I really wanted to, I could average down. I just don't have the capital to do that right now, and I'd rather go into Microsoft and Amazon than buy more into the ETFs that are here. Now, I'm also into gas. Not all gases are performing well right now. Exxon is performing very well. As you can see, I bought at 105, and at one point it was all the way up to 118. Now, October hasn't been nice to Exxon, but at one point we were back up to that 118 number. And Enbridge is just getting worse and worse. We bought way up beyond the bridge of the chart, and we are down to under $34. It's actually even lower than that now, but Enbridge has fallen a lot. I believe it's because of all the acquisitions it's doing and all this other stuff that's adding to its debt to equity ratio. It has regulation issues, especially in Canada, as it's a Canadian company with Canada's having a lot of environmental laws go through right now. So Enbridge is not doing great, and its share price is showing that. But again, I'm in Enbridge for the dividends, and they still are having a healthy 6 to 7% dividend every year. Exxon is just another one of those. It has a healthy, I believe it's like a 3 to 4% dividend, and the share has a lot of room to go. And I think as it acquires more and as gas prices go up, I believe Exxon has a lot more room to grow, even though it is volatilely bouncing between that 105 and 120 mark, and it has been for the better part of the last 2 years. So we went from mostly profitable stocks to only having 2 profitable stocks, well, 3 including Exxon, but only 2 profitable stocks right now. That would be Walmart, which my average purchase price was $140, so not even on this chart, but it is way up from here. And Ares Capital, or ARC. And ARC is also way up from where I bought it. Now, both of these, I'm mostly in it for the dividends. ARC gives out because it's a special kind of company that has to sell out 92% of its profits in dividends in order to qualify for its tax advantage position. They're always paying out like a 10% dividend. So money in Ares is not, even if I don't pull out, I've made a lot of money in Ares and will continue to make more as the year goes on. Walmart, not as good as a dividend, but a very good performer nonetheless. And as we kind of go into a recession mindset, more people shop at Walmart because the prices are cheap, the quality is good enough, and it doesn't matter if you're really rich or really poor. Like, you're going to Walmart to save money because we all want to save money. And Walmart is that brick and mortar store that you can go to as a grocery store, as a general goods store. And if you need something that is just going to be cheap and usable and just will get you through this hard economic time, you're going to Walmart. Now, one might say, hey, well, why not invest in Dollar General then? Dollar General's share price is doing atrocious. It's down by 75%. Dollar General it used to be one of my favorite recession stocks, but even though its balance sheet looks good, I'm not thrilled with it. So Walmart seems to be the better recession retailer that I'm more interested in. Plus, they're doing a lot on their revenue side and new revenue streams, especially with their online store and how they're trying to target new customers with delivery. I find Walmart to be the better recession retailer, even over like a Dollar General or a Dollar Tree. So Walmart is where I'm staying, and I'm very happy with it for my current economic thesis. It's why you will see me in gas and in consumer items that I feel are going to do well in a bad economic time. Now, if you look at my actual portfolio, that is a lot of red. Now, Amazon and Microsoft, I had to add to my account in order to get, it wasn't just reinvesting dividends, I also put more money in. So that's why the total cost of trade went up over last year. It went up about $2,020. So yes, I am up over the amount of money that I put in, but it's not as much as you would think compared to where we ended last month, which was at $46,000. So it's not a $2,000 gain. It's just I've put more money into this account. But yeah, the overall general market has done so bad, and Enbridge especially has done really bad to the point that it's wiped out any gains from Exxon or ARC or any dividends that we've reinvested, and we're only up about $100. That said, our annual dividend per year is, $1,600, so that is very good. It's 3.4%. It's not as good as a high-yield money market right now, and it's not even as good as bonds right now, because bonds are going for 5 to 6%, depending on where you're going. But I am going to try to still get some good discounts from where we're trading now and the massive oversell-off that we're seeing. So I'm not overly worried. I like the 3.4% in dividends plus whatever I can get on the upside of share price, especially as we come out of this really, really turbulent time. Now, if we're to amortize this down to the month level, making about $136, $137 per month on about $48,000, I'm happy with that monthly amount for the amount of money that's in there. Could I be making more in other less risky assets? Yes, but I do I still see that there is value in being in these broader market ETFs and in some of these single stocks. I don't think any of them are overvalued at the moment. I think Exxon is a bit more volatile, especially bouncing between that 105 to 120 mark, and it does it fairly cyclically. Walmart, we're going into the holiday season. I think that still has more room to grow, and I think they're going to have a very good quarter. ARC is a pure dividend play. Their balance sheet looks really great, but I'm mostly in it for that 10.6%, which is really bumping up my dividend yield overall. Enbridge, same thing. I'm in it for the 7%. The stock price has really tanked, which means this is a good buying opportunity to average down. But I don't have the $3,000 I'd want to add another 100 shares to it. Same for Microsoft and Amazon. I think that they've been sold off enough that they're worth buying back into. I think Amazon especially should be around 150, 160, and I think this is a good spot to start buying again at it. Microsoft, same deal. I think their fair market value somewhere around 340. I do want to see it back off a little bit, maybe hit like 310, and if I had some dividends to reinvest, that's where I'd probably put them, as Microsoft and Amazon. I think their balance sheets look very good. The broader market ETFs, they're in a massive sell-off. Now would be a great time to buy. Again, I don't have the money to put into this, so I'm not, is the short answer. I could sell other positions I have outside of here to put more money in, but I'm not enjoying like where these ETFs are right now. I think they have a little bit more to fall, especially in October, especially with the macro data coming out right now. I think there's a lot more fear in the market, and I think there's some more to go down. So I might sell off a couple of other positions I have and buy into these ETFs, but I'm not 100% sure where I want to go. And that's more of an October discussion as I wait, watch, and see what else I can put into this portfolio. So I'm happy with the dividends where they are. I'm not thrilled with the fact that I've lost so much money this month, but again, things are going to get worse before they get better, and then eventually they will start going. I'm not in this for the short term, I'm in this for the long term, and I am trying to hold through the bad times. So yeah, here's the actual ones I crawled back to. You can see I made $2,000 on both of them by selling where I sold them. So we are technically still at a profit overall, even though the shares are down from where I bought them. So we are still technically up just around $2,000 total, $4,000 total for the two. So you can see sold in July and we moved back in late September. Here are steady goers, especially with the dividends. Walmart's paid out 3 of its 4 dividends for the year. Actually, I think I missed the January one, so I think all 4 are done for this year, and the next one I will see is in January. And then ARC, again, fairly consistent, about $90 each time, and I'm very happy with ARC right now. I made almost $200 in dividends, plus the share price being up from where I bought it. We're at a very good, very healthy profit and loss for the considerably less capital I put into it. Now, if we look at, some S&P stocks, yeah, there was a fall in the fall, and it's going to keep falling going into December, probably. I would guess October is going to be the worst. November's probably going to it's probably going to be flat to slightly down, and then we'll start to see a pickup in December, especially in Q4 earnings, so December, January. I think as fear kind of lessens and we go into the holiday season, I think we'll start to see a bit of a turnaround, and if we don't, again, buying opportunity. So we'll see if we add to this, but right now, yeah, the S&P stocks are not doing good. Though we did just get $7 in dividends, so I mean, yay. And then oil. So Enbridge is paying out about $110 after Canadian taxes. That's what the $19 is there. That's a Canadian VAT tax that's taken out automatically because it's a Canadian company. The U.S. doesn't automatically take out taxes when you get dividends. That's a end of the year 10K issue. So I'll deal with all of that come April. But you can see where we've added to positions. We haven't added to anything really recently, but both Exxon and Enbridge paid out, Exxon paid out $90, and Enbridge paid out 110. So we're just collecting on the dividends, and yeah. Now, just how bad was September? So at the beginning of the month, we had just shy of $47,000. At the end of the month, we had 48 and a third. Now I funded the account $2,200. So that math don't math, and we lost money month over month, about $700. However, our profit loss since open is about $122, not including that $4,000 that we pulled out. This is excluding that. This is just current stocks and what they are currently valued at, not what I've already pulled out from those other two trades. So we're only up about $120 year to date. Now, some deja vu. Here are my exit prices for Microsoft. If you remember from the beginning of the video, I kind of showed you in the chart. Well, our total realized gain was just over $4 grand. We re-entered here at 317 and 130, 129. So we did re-enter at lower prices and didn't lose some of that money that would have come from holding on through this whole time. So I am happy that we sold. If you remember the last market diary, I was kind of like kicking myself because Amazon zoomed so much. But then September happened, everything went bad, and now I'm like, all right, well, there's going to be some ebb and flows. There's a lot of volatility. Don't beat yourself up and just buy and hold. You don't think any of these companies are going out, so let's buy and hold. Deja vu electric boogaloo. Let's talk about the S&P and just how bad it was. So S&P 500 losses. We lost about $800 on the overall S&P 500, which is about 5% of what I've put into it. Now the small caps, we've lost about $300. That's about 8% from what I put into those stocks, which means a grand total of just over $1,100, or a 6% loss of all the money I've put into this total S&P, the total S&P ETFs. So we're down about 6%, about $1,100. Not a great feeling, but I have a feeling that a year from now, this will be much better. So, September dividends. Let's talk about the payouts that we got this month. We got Walmart, we got Exxon, we got Enbridge, we got ARC, we got the small cap, and we got the small cap growth. That was a total of about $330 in dividends. So even with the losses, we still technically got a realized gain this month because we didn't get a realized loss. So long as I don't sell, you haven't lost anything. And I don't think that there's going to be a total market collapse. So we're going to hold through the pain and just see what happens. So I've kind of alluded to it. What's my plan for October? We're going to reinvest any dividends that haven't already been reinvested. There's still like about $170 that I still need to invest. Don't know where we're putting that yet. If I'm able to buy the dip, I want to buy the dip. I just, like I said, I don't have the capital put into it right now, even though I see this as a buying opportunity. I think the market's just really oversold. And then hold through the pain, because yes, it is very hard to see your account value going down. I'm not immune to emotions. I don't like seeing that I'm losing money, but I also know that you haven't lost until you sold, and we still have more than enough time to make up for the losses here. Like, I don't need the money today, and so long as I hold, we have a chance to make it back. And, I think the U.S. economy is strong enough to, keep going up, even through the bad times. I don't think we're going into a place where we're just going to be in stagflation for the next 10 years. This isn't the 80s. I think we have some good upward momentum that we can actually do. So, reminder, here are my rules, and here are my general disclaimers. Thank you very much for watching. I will see you all in November. Bye.